Good morning, everybody. It's Tuesday, April 14th, and this is what is topping our agenda. Stocks rally as the S&P recoups its wartime losses. Talks about peace talks lift the mood. But luxury stocks could retreat after a reality check from LVMH.
So those talks about talks lifting the futures picture when it comes to European stocks, pointing higher by 0.5% after closing lower by just around 0.2 lower by the close yesterday. S&P futures then stateside currently flat, but after the gains of yesterday, Brent now down 0.9%. A little bit of pressure coming through on oil prices, at least so far in today's session. The countdown to the opening trade starts right now.
Tuesday morning, good morning. So there's a lot of debate out there as to why stocks are doing what they're doing. Why are stocks? Why is the S&P back to where it was before the war started? Number of different kind of questions that orbit around this key question. Who's buying? Maybe it's the CTAs. Is it retail? There's a lot of evidence that maybe retail isn't back into the market. Why are they buying? Well, clearly the trade is on. Look at the SOX index. Look at it absolutely flying. So that AI trade is definitely on. But elsewhere, there seems to be a lot of hope baked into this market right now. Hope that maybe the economic agenda is not going to be derailed by what is happening with energy stocks. Hope that actually earnings are going to hold up and they're going to look great. So there's a lot of hope baked in. But there's a lot of questions here. I don't have any answers this morning, just a lot of questions.
Yeah, a lot of questions. And some of them going along the lines of, does it make sense that stocks are doing this when oil prices are $30 higher than they were when the war started? And we've erased all of those expectations about Fed rate cuts. So despite both of those things, stocks have gone back. And yes, we've got a ceasefire, but it is shaky and limited. Despite all of that, stocks have gone back to these levels. I mean, JP Morgan and Morgan Stanley, you mentioned the Morgan Stanley note yesterday, I think, Guy, but JP Morgan joining in with that and talking about how geopolitics represents a time to buy the dip. So that could be underscoring people's decision making here. And BlackRock going overweight US stocks again. They'd retreated from that and deciding that now was the right time to go back to the overweight stance.
And Guy flagged the call from Mike Wilson yesterday towards the end of the show in terms of wanting to get exposure to the equity market. John Authers' piece today as well looks to answer some of those questions. Equity markets, risk assets, impervious, it seems, according to John Authers. That's his analysis of what is actually going on, the physical restrictions in terms of crude, but other commodities as well. Is there a point and time when that gap has to close? And that seems to be a key question. Polymarket odds, by the way, and again, John Authers citing this in his piece, 20%, just a 20% chance that the Straits of Hormuz reopens this month. And so there's very little expectation that reopens. So at what point do we have that catch up as markets, for now, look through and focus on those talks about peace talks? So I'm
paying quite a lot of attention to the front end of the US curve. You look at what is happening there. There's a hint within that market that maybe actually there is going to be some economic damage that comes through from this. You're already seeing it elsewhere in the world. There is clear demand destruction beginning to take place in other parts of the world. And you wonder whether that comes to Europe, whether that ultimately comes to the United States. And if the economy slows down, can earnings hold up? Can the stock market deliver the kind of the rate of return that people are anticipating right now? I don't know. I don't know. There's so many questions, but if you look at different markets, you're getting different answers.
Yeah, absolutely. One of the reasons that we do see some of this hope in markets right now is the talk about talks. So we've heard from people familiar talking to Bloomberg News suggesting that the US and Iran are talking about coming back to the table to try and do a bigger ceasefire deal before the expiry of the 2-week window, which is around April 21st, isn't it? So if we can get that, and if we can have more luck in bringing these two sides together, then maybe that is a justification for some level of hope. That seems to be one of the things that is underpinning the market moves right now. We're also watching from an all-market perspective, watching the Wall Street Journal had a story about how the Saudis are putting pressure on the Americans to end the blockade because they're nervous about what the Houthis might start to do around the Red Sea. And that's where Saudi has been sending the oil that it can export at the moment through a pipeline.
Others have been more cautious. Certainly container vessels going through that route haven't come back to the levels they were pre the Houthi attacks. But the Saudis are clearly worried that they won't be able to use their pipeline and get the oil out. Just shows you that this story could escalate even further, and that more damage could be done. But you look at plastics prices, ethylene, all these kinds of stuff, they are up sharply. Metals markets pricing in a sharp uptick. Aluminium, you were talking about that on our call first thing this morning. Look at copper. All the input stuff that you put into an economy to make it run is up sharply. Inflation, in theory, should be coming.
Dan Curtis, our graphics and charts whiz, pointing out to us yesterday that a Japanese toilet company has had to stop fitted bathrooms in Japan because they can't get the components that they need to do that. So that's happening in Japan. The IEA, Fatih Birol, we're going to get the IEA report out later today.
9 o'clock.
But Fatih Birol coming out with these numbers, just pointing to what he's described as oil prices down again in the session today, or at least down in the session today, not reflecting, as he says, not reflecting the severity of the problem. About 13 million barrels a day taken out as a result of the conflict and the closure of the Straits of Hormuz. More than 80 energy facilities damaged in the Middle East. And again, this line stood out to me from Fatih Birol. The prices are not reflecting the severity of the problem. He says there's going to be some catch-up.
Which prices?
Yes, indeed. I mean, also, if we're looking to China to apply some pressure on Iran in this situation, a lot of voices raising questions about whether that's going to happen. And we've seen some of the data, which I know we'll get to shortly, around Chinese exports and imports. But the suggestion being that they're maybe protected from what's going on with Iranian oil, not disinterested, but slightly protected by the fact that they've stockpiled so aggressively on land, and also some of the floating Iranian oil that is out at sea that they would have access to. So that is certainly another dynamic that we're watching.
And we can think about the China story when we think about earnings. We're in earnings season. It's a bit of a mixed picture. Yesterday we had Goldman Sachs, LVMH, two of the standout names reporting numbers. China actually performed quite well for LVMH, but the headline that stood out to me was the 50% drop in sales out of the Middle East for LVMH. It's not a surprise, of course, that sales have dropped in the Middle East given the conflict and people not wanting to go to those shopping malls in places like Dubai. It's 6% of the market for LVMH, the Middle East, a 50% drop in sales. That was well above, in terms of the drop, a much bigger drop than many analysts expected. So that's just one example of how, at least on the consumer side, there's a retracement certainly in the Middle East. It was interesting that China came out came through better than expected for LVMH.
And the US held up, which I think is interesting as well. I have this kind of LVMH theory that relates back to stock markets, that if you see a slowdown in luxury spending, are people going to be investing? I.e., if you're cutting back on discretionary handbags, do you continue to invest in the stock market? But at the moment, it looks like certainly the upper end of the US consumer is holding up quite well. Does that tell you that that cohort is going to continue to invest, continue to support the stock market, continue to do what it has been doing thus far? Can you draw a line between these two?
Yes, indeed. I was listening to Andrea Felsted on the last hour of programming, being quite upbeat, actually, about the underlying story that LVMH had to tell. And this comes as we wait for a host of other earnings to come through from the luxury space. So we'll see what take we're getting there. We've also heard from the banking sector. I was drawn to the Publicis numbers just out this morning. They're confirming their guidance despite the macro situation, and that's in the advertising sector, which is notoriously volatile and vulnerable to macro headwinds. We're just getting numbers out of BP as well, saying that their expectations now include the impact from the Middle East situation. Of course, this is a business that could benefit from higher energy prices, but they won't want to be seeing demand destruction.
And particularly the trading arm of BP could benefit as a result.
But in some ways, these oil companies are banks. They are Goldman Sachs trading revenue. Let's look at what the big oil companies. What has supported them and given them less volatility has been trading, and it looks like they're seeing exceptional trading in the first quarter. Yeah, we will watch for reaction in the share prices of some of these European companies at the start of trade. That's some, 52 minutes away now. Let us tell you what is coming up in the programme in terms of the guests we're going to be speaking to. Navin Kumar will be with us from Drury, Maritime Research Director for bulk shipping, so whether that's liquid bulk or the less liquid variety. We will certainly talk about what he is seeing in terms of flows around the world. Peter Oppenheimer will be with us from Goldman Sachs, Chief Global Equity Strategist. Really important time to talk about what is underpinning this hope in equity markets. We'll also be hearing from Eva Mann, the ING commodities strategist. A great time to talk about, aluminium, also the oil and energy story, of course, in focus.
Here's what else we are going to be watching throughout this Tuesday. 9 a.m. UK time. It is that IEA oil market report, so we'll bring that to you, of course, when that breaks. 1:30 p.m. UK time. US core producer prices, so we're gauged there in terms of the inflationary impacts in the US. European earnings, we got carrying in the luxury space after LVMH yesterday. Total, talking of the energy space, of course, sales and revenue come through. And on the earnings front, when it comes to banking, JP Morgan, Wells Fargo, Citi, plus BlackRock reporting as well. It was interesting that despite the drop in Goldman's share price, financial services actually ended up as the top sector, both in Europe and the US yesterday. 10 p.m. UK time, Christine Lagarde speaking in Washington, D.C.
Looking forward to hearing what she has to say. What else do you need to know this Tuesday morning? China's export growth slowed sharply in March while imports surged as seasonal factors combined with the fallout from the war in Iran on global energy supplies. Exports rose just 2.5% from a year earlier, missing forecasts after a gain of almost 40% in February. Imports, meanwhile, surged at the fastest pace since late 2021, leaving a trade surplus of $51 billion. American Airlines shares have climbed in late trading in the United States after Bloomberg revealed that United Airlines CEO Scott Kirby is said to have floated a possible combination between the two businesses. Sources say Kirby has pitched the idea to senior government officials. A merger could create the world's biggest airline, probably generating some fairly serious antitrust concerns, I would have thought. Look back at JetBlue, Spirit, and what happened there maybe as an example. And finally, Pope Leo has vowed to keep criticising the US-Israeli war on Iran, hours after President Trump blasted the pontiff and opened up a fresh political rift with his Italian political allies. Leo told reporters he will continue to speak out, quote, loudly against the war and promote dialogue and multilateral relationships.
Interesting dynamics to watch. Coming up on the programme, we track the Rich Starry. Now, this is a US-sanctioned tanker. It's linked to China and to other countries. It's been making its way through the Strait of Hormuz, making some progress, in fact, in that mission. What kind of test of the US naval blockade is this? We will get to that conversation later in the programme. Plus, an unexpected earnings miss by Goldman Sachs rattles investors, certainly on the fixed side of things, the fixed income side specifically. That was the kickoff of Wall Street earnings. We will dig into the wider implications. We have a host of other Wall Street banks reporting this week, of course. And up next, we'll be joined by Florian Yelpo, head of macro research at Lombard Odier. We'll talk about inflation, the latest inflation dynamics, and what that means to him and the team. We love to hear from you. IB plus BBTV Go is the function on the Bloomberg terminal if you'd like to get in touch with the team that puts together this programme. This is Bloomberg.
Right now, there's no fighting. Right now, we have a blockade. They're doing no business. I didn't like seeing boats come out if they were doing business with Iran, but if they weren't, no boats came out. So now Iran is doing absolutely no business, and we're going to keep it that way very easily. Don't forget, their Navy is gone, their Air Force is gone, their anti-aircraft is gone, their radar is gone, and their leaders are gone.
President Trump speaking to reporters outside the White House after he began a U.S. naval blockade of the Strait of Hormuz. The move aimed at increasing pressure on Tehran, of course, even as sources say that the two countries are considering another round of talks in hopes of securing a longer-term deal. Let's get the latest then from Bloomberg Horizons anchor Jumana Basecci. And I suppose that underscores the hope and some expectation in these markets then, Jumana. The reporting that we have that suggests that the U.S. and Iran are thinking about coming back to the negotiating table before the expiration of the 2-week ceasefire.
That's right. And hope is the word here. But I will say that President Trump did say last night when he was speaking to reporters that they had received a call in the morning from, quote unquote, the right people, and that Iran wants to make a deal. Later on, J.D. Vance was giving an interview to Fox, and he was asked about the potential for another round of discussions. And he said, you've got to ask the Iranians. The ball is in their court. So the understanding from that is that the U.S. would like to see another round of discussions. And overnight, again, we heard from the Iranian President Masoud Pezeshkian, who did indicate that the Iranian side would be willing to continue with discussions so long as they were done within the, quote, framework of international law and regulations. So our colleagues out with the story overnight suggesting that they do want to get this done before the ceasefire expires. That is set to happen on April the 21st. There's been a big push from the mediators, once again from Pakistan, alongside Egypt and Turkey, to push forward with the discussions and bridge some of the outstanding gaps. There are a couple of points still outstanding that we had been reporting over the weekend, including the nuclear file and the fate of the Strait. But what we understand is if the meeting does take place, it would happen in the next few days. Unclear where it would happen. Islamabad is one option, but also so are the other countries that are mediating. Could happen in Egypt, in Turkey, and possibly even Geneva, which is where those series of nuclear talks took place before the war even kicked off. Now, when it comes to the Straits, we spoke about this yesterday, but clearly the effective blockade that the U.S. has now instituted as part of the sequencing that they see and they feel needs to happen in order to return back to the negotiating table, wresting back that point of leverage from Iran so that when they do have this next round of discussions, the Strait is no longer a point that they have to negotiate over. And in fact, they want to really emphasize and really focus these talks around nuclear ambition. New York Times reporting overnight that there was some level of agreement about suspension of Iran's enrichment activities. Iran have been pushing for 5 years. The US want a longer time frame of 20. But again, it feels as though we are working towards perhaps what could be a workable compromise between the two sides and another potential meeting taking place this week, all which of course would be good news. And I will say over here in the region, the ceasefire is still being held up.
Which is great news. And maybe this accounts for why we are seeing stocks doing what they're doing right now. Hope of a deal seems to be being priced in. Jumana, thank you very much indeed. Jumana Basechi joining us out of Dubai. So, as we say, the S&P's raised its losses for the year. Traders looking cautiously optimistic that the rally that we saw last week, which was driven by ceasefire hopes, can actually continue. Does it make sense? Florian Ielpo, head of macro research at Lombard Odier Asset Management, joining us now to discuss. Florian, good morning. Does it make sense that the S&P has now erased its Iran war losses?
Should make sense from two different perspectives. The first one is this is geopolitical risk. This is globally a limited oil shock and by nature something temporary. So at some point markets are known for looking ahead and being in this position to look through the current risk. That's the first thing, the first reason I think why markets are trading on de-escalation rather than resolution. The second thing is there's a Trump playbook that we've learned last year during the tariff situation. And at that point in time, we had a shock, and then we saw progressively some sorts of we started with the worst case scenario, and then that scenario improved progressively, and market was very happy with that, repricing progressively the positive very rapidly, and this gave momentum to a rally into year end. So maybe we are exactly in the same situation. All parties normally should have an incentive to agree at this point in time, and this agreement should bring a resolution at some point. So markets are in this mindset of trading on good news, trading on improvement, rather than trading on a good situation.
Are all markets sending the same message? If I look at the front end of the US curve, maybe it's beginning to tell me that actually a slowdown is not something that I should ignore. If I look at what is happening in the energy markets, in the commodities markets, telling me maybe that inflation is on the way. Are all messages the same here from all markets?
I think there's a very big difference between what happens on the fixed income side and what happens on the equity side, because they're not trading on the same risk factors. In the case of fixed income specifically, think of what the interview from Donald Trump just said. The one thing which is not gone is actually inflationary pressures, and the fixed income market needs to reprice that risk. Okay, this is an important element because let's say monetary policy is a number one factor of the fixed income market. On the equity side, it's a very different situation. What happens when you have an inflation situation with slightly more elevated rates on the equity side is that normally it terminates multiple expansions and opens the door to a market progression based on earnings progression. So what we need to see right now, and what actually market are actually pricing at the moment, I think, is an improvement in the earnings situation. This is a very key variable. If you want to see your equities higher by year end, you need that improvement on earnings. Now, what the market is pricing is 14% progression in 2026 in earnings growth. So it's already a very high bar, at least that's what I think. And with this high bar, we need very positive surprises. That's why the micro data at the moment is probably even more important than somewhat the geopolitical risk that surrounds us.
Florian, good morning. Is there a risk that markets are underpricing margin compression for corporates in this earnings season?
It's about
OK, I think we have a technical issue with Florian's
He's still
line.
talking. I can see that he's still talking.
Live TV, we'll try and reconnect with Florian, but his insights there, you were talking about whether or not, of course, the return to pre-war levels for the S&P 500, whether or not the optimism we're seeing broadly in equities is justified. And he said, essentially, the markets are trading through and looking to a potential resolution. They're not focused on whether or not the scenario is there now, but they're looking at a potential resolution into the future. And then towards the end, he was talking about the corporate earnings story and that expectation that there's going to be strength there.
Are we going to get the same? Are we going to get confirmation of that on the earnings calls? Is that what CEOs are going to tell us in the earnings calls that are going to be happening over the next few weeks?
Yeah, it's really early days, isn't it? We haven't had very many of them yet. The Goldman Sachs call, I mean, the US banking story is a couple of steps removed from the epicenter of all of this, of course, but still very interesting views on what's going on in the Middle East and how much it impacts on what they're doing. You did get a sense that market expectations in that case around FIC, still pretty high. He had to come out kind of fighting, saying, look, this was the 10th best quarter for FIC trading we've ever seen. It's really not that bad, guys. And yet the market was demanding something more. So despite the macro headwinds, it seems as if maybe the market is still quite demanding of earnings stories.
HSBC's CEO, speaking to our team over in Asia, and we'll be playing some of that tape of George Elhedery saying that sentiment is now starting to deteriorate a little bit as a result of the conflict in Iran. He's starting to see that from clients. So that's a bit of a warning from HSBC's CEO. On the Goldman story as well, I mean, talk about FIC and there was disappointment there. But the equities team, the best record ever, best quarter ever on record for any bank ever in terms of, so benefiting from volatility. You were talking about BP talking this morning as well about its trading team and its energy trading team benefiting from that volatility.
I understand that Florian Nielpo is back with us. So I do apologise, Florian, for the communications breakdown we suffered there, but we were enjoying your contribution. If I could take us on to pricing power and how much you think this is going to be a topic of conversation during earnings season, Florian, because we've seen this in periods of inflation before, where corporates can actually ride out consumer-related headwinds, perhaps, if they do have sufficient pricing power.
Yeah, true. I think this question of pricing power actually ties also to the question of margins in the end. So I think we haven't changed the overall narrative of 2026. We've marginally seen an evolution of it. That evolution coming from the high oil prices. What I'm trying to say here is that AI is still something which should matter to our investment perspectives, and AI has this ability to improve margins across the adopters companies. Plus, as you know, the capex element is also something we shouldn't be ignoring. But the key point to answer your question is. True, we should see an impact and compression on margins coming from oil prices, but we have the ability. Some companies have the ability, to pass on that increase in oil prices to their consumer, and we're still seeing vast stimulation coming from the fiscal side, which shouldn't be ignored, which helps dampen, if you like, the shock. And the other shock dampener, of course, is the improvement in margin coming from technology. And this technology element is something that is on the background of 2026, but with that we shouldn't ignore still in the current situation.
Florian, you talk about AI, and we've seen that significant rally in semiconductor stocks again. But it's not just semis, it's the optical story, it's the memory, it's everything that's playing into data centers. What do you make of that? Is that sustained? Is that a demand story? Is there much further to run on that piece, just briefly?
I think it's important to go back to the kind of environment in which we are to answer that question. We started the year with this Goldilocks narrative. Now the soup is actually getting warmer, as you know, because of the oil shock. The one let's say problem we had with this Goldilocks situation and how positive it can be for stocks was the expensiveness of the stock market.
Florian, we've run out of time. We appreciate your insights. Florian Nielpo, head of macro research at Lombardia Odier Asset Management. Plenty more coming up. Stay with us. This is Bloomberg.
Tuesday morning, good morning. 30 minutes to the start of equity trading here in Europe. At the moment, futures are pointing positive. We are up, let's call it circa 0.5%. That's certainly what the Euro Stoxx 50 futures are calling. Looks like you're going to see a bit of outperformance coming through from Germany, underperformance coming through from the UK. Watch BP, watch Publicis, and definitely this morning, watch LVMH. How does it trade after yesterday's news, which some are seeing as soft.
Yeah, absolutely. So we'll watch the luxury sector, in fact, broadly on the back of that as we are deep into or getting into the earnings story around luxury. This is the picture on bond markets then. We have buying happening at the 10-year horizon. I can see pretty much across the board for European bond markets. Those yields coming down. They're down 6 basis points actually over in Italy, down around 5 basis points in France. So some pretty substantial moves. And if this is attached to the same narrative around where we go with Iran, then these are some quite chunky moves that we're seeing this morning. I will flag, of course, we've got some central bank speakers later on today. I think a lot of ECB speakers this week. So we'll certainly watch for any guidance, any direction about how the market deals with inflation right now. Tom?
Yeah, and on the oil story and on that blockade, that US blockade, we are monitoring as well a sanctioned tanker linked to China that is currently defying that newly implemented US naval blockade by sailing through the Straits of Hormuz. Just as the blockade came into effect, the ship, which is called the Rich Starry, made its way into the narrow waterway between Iran's Qasem Island and turned back, only to restart at exit just hours later. So a bit of hesitation, it's restarted. The transit is testing Trump's resolve, of course, and has put global energy markets on edge as traders wait to see if the US will intercept the vessel. So far, it has managed to sail at least partly through the Straits of Hormuz. We continue to monitor, as do markets, and we'll see again if there is US naval intervention when it comes to that now Chinese-flagged vessels. Let's get some insight and some expertise in terms of what is happening more broadly across the maritime space and shipping, and bring in Navin Kumar, Director of Maritime Research at Drury. Navin, good morning. Thank you for taking the time. What currently is the impact that you and the industry are seeing as a result of this US blockade? Still just in the early innings, of course, but what is your assessment so far of the impact after a Sunday where we did see a bit of transit through that strait?
Thanks a lot for having me here. I think the impact is unprecedented. In the past, what had happened that, blockade would be partial. Even when Iran had said that it has blocked the Strait of Hormuz, there were still vessels passing through. Albeit, there were different arrangements when vessels would pass through the Strait of Hormuz. But now, as we are seeing that the transits have virtually come to a standstill, at least that is what is showing on the AIS data. But we are actually of the opinion that there are still some vessels that would pass through the Strait of Hormuz. And, it doesn't actually it isn't as straightforward as it seems on the face of it, because most of the vessels that pass through there, their AIS signals are not very definitive. So you cannot say with surety that the Strait of Hormuz is completely sealed. But in the current situation, it is definitely a case where it is more difficult to pass through the Strait of Hormuz than it was a couple of days ago.
And what then is that doing to freight rates? Now, then, is there further upside pressure on freight rates, or have we reached a peak?
No, I think there is further upside on the freight rates. Why I say this is because a number of those vessels are laden, some are in ballast. So effectively, the supply that would otherwise be carrying cargo is doing nothing. So basically that supply has been soaked up, doing nothing. So there is short-term pressure on freight, but if this blockade remains for long, we expect the freight rates to settle down gradually.
Navin, can I ask you about insurance and the insurance reality for shipping companies right now? We heard the insurance industry, saying in the early days of this war, after the initial days, I suppose, that there is insurance provision, but that isn't the only story. That isn't the only thing that makes the decision as to whether captains will go through the strait. So, how safe is it, and how much is that being reflected in the insurance availability?
So, insurance is a very important factor in deciding whether the ship will pass through that Strait of Hormuz or not. And ever since the war broke out, the insurance premiums have already gone through the roof. Pre-war, it would be somewhere close to 0.25% to 0.5% of the, but that has already risen up to 5% in some cases. But these are just the numbers, no definitive confirmations, because they aren't available, honestly. But I've spoken to insurers. Most of them are very reluctant to offer insurance, and those who are offering, they are charging atrocious premiums. So without an insurance, I think traveling through Strait of Hormuz is not safe. Many ship owners are very reluctant to go through that passage without any insurance. Even with insurance, the crew, the staff, they are not very comfortable going through. So there is definitely an issue of safety concerns around the passage through the Strait of Hormuz. But since the war broke out and Iran had given a little leeway to allow some vessels to pass through, at that time we saw some vessels were able to get insurance, albeit at a very high premium, but it hasn't vanished completely. There are still some vessels which are able to manage insurances and able to pass through.
Navin, this is obviously a very fast evolving situation. Do you think that everybody in the shipping industry has all the information they need about exactly the terms, for example, of these various blockades? The people you speak to within the industry, does everybody have all the information they need? I was reading some Bloomberg News reporting that suggested that some traders were deciding not to trade until everything was a bit clearer.
Yeah, nothing is clear. The situation is evolving continuously. Nobody has any clarity, including authorities which are dealing with these passages. So there are, different versions of truth, if I may say. And neither ship owners, nor traders, nor insurers, nor port agents, nobody has absolute clarity as to how one can pass through this Strait of Hormuz, or how the trade can be reinstated. What are the timelines? There are just too many moving parts in the current situation, and decision making is very, very difficult at this point.
Navin, good morning. It's Guy. The Saudis are worried about what could happen in the Red Sea if the Iranians bring in the Houthis and close that waterway as well. Can you talk me through what impact that would have? How many ships are currently using it? Is it just the Saudis that are using it mainly to exit their oil via the pipeline? Just talk to me about what it would do to the global shipping industry if the Red Sea was also significantly shut down from where we are now.
So, just to put things in perspective, the East-West pipeline can carry about 7 million barrels per day of crude. And about 2 million of that is being used by the Saudi refinery in the Red Sea. Rest 5 million barrels can be shipped out to the rest of the world. Now, if that Red Sea, if there is a blockade in Red Sea as well, that supply goes away immediately. So, the respite that we have right now because of the additional supply, that will go away. And, it's more important for the container trade, because that container it's a key routing point for containers. And if there is any issue in the Bab al-Mandab, then we are in for big trouble. The freight rates may see massive rise, which we are already seeing. But at this point, we are not seeing so many activities in the Red Sea. But if that were to happen, that would be very, very difficult for the shipping.
Okay. Final question from me. If it ended tomorrow, if this conflict ended tomorrow and everything reopened, how long would it take to get back to normal?
We believe that it's a structural change, and things are not going to go back to normal, or at least not to the pre-war era, because there are certain things that have changed forever. This war has shown that Strait of Hormuz can be closed. It's a real choke point. So the strategies of ship owners, traders will take that into account, and their future strategies will revolve around, this risk. They will factor in this risk. The other important part is the damage that has been done to the energy infrastructures in the Persian Gulf. Ras Laffan LNG terminal, Ras Tanura refinery, and many other important infrastructures have been hit, which cannot be reinstated overnight, even if the passage were to open and if we go to business as usual. Even then, we expect that the full recovery will take perhaps years.
Does that suggest, Navin, that we don't see a repeat of cycles that we've seen in shipping in previous instances where you've seen a tightness, you've seen disruption, and then you've seen a glut of shipping coming on to meet that, and then you see freight rates tumble? Is that a scenario that doesn't play out this time because of that, what you see as fundamental long-term shift?
So, I'll dwell upon a little bit on the freight rates, how we see freight rates going forward, and I'll also touch upon the shipping cycle later. See, right now there is supply shock, and anyone who can get their hands on any vessel that is available to sail, they would go and try to acquire it, at least for charter. But this frenzy will settle down because the inherent problem is the supply won't be available if it stays for long. And even if it settles down, let's say in 2 to 3 months, there will be supply issues. The rest of the world cannot bridge that gap that has already been created in the last 1 month and a half. So there will be fewer cargoes to ship, and as a result, we will see that the demand for ships overall will decline. A part of that decline can be covered through long-haul trades, because Asia, which was sourcing its energy from the Middle East predominantly, will have to look elsewhere to bridge that gap, and that elsewhere is very far off areas like Latin America, US, West Africa. So that in the short run, freight rates will go up. In the long run, after this war is over, we expect freight rates to settle down and come down drastically from the current levels that we are seeing. Now, talking about the shipping cycles, I think it's a larger issue, and it doesn't get affected by 1 or 2 black swan events. Shipping cycle will continue. However, we may see changes in the shipping cycle. The ordering cycle may become longer.
Yep.
Demolition cycle may become shorter.
And that obviously balances things out. Navin, great to catch up. Really appreciate the insight. Thank you very much indeed. Navin Kumar joining us from Drury. OK, let's talk more about what we are seeing in these markets and the different views that are out there. I have to say the IEA, which is about to post data at 9 a.m. London time, is quite worried. Its executive director, Fatih Birol, certainly says that the world is facing a significant security challenge, an energy challenge, as a result of what is happening in this Iran war.
The scale of the problem is huge, and countries will suffer under this. Some more than the others, but I can tell you, no country is immune to this problem.
Fatih Birol speaking there yesterday. We'll get more data from the IEA shortly. We'll have more on the energy picture on this show next. This is Bloomberg.
In many ways, I think markets are seeing through the conflict and are also hoping for a resolution.
Both parties, Iran and the US, actually see themselves as being in the stronger position, relatively speaking. So it makes them really reluctant to actually make any concessions that are going to be necessary to end this conflict.
We have seen bigger crises beforehand, so the market is still pretty resilient despite all the bad news that we have every day.
We expect to see the market disruption continuing, and the longer this goes on, I think we'll see a broader GDP impact. As long as we can retain it below $100 a barrel, we're likely to see continued growth.
guest on Bloomberg TV there, weighing the impact of the war in Iran on markets. Let's turn now to today's markets in 3 minutes. On the opening trade with Markets Live Executive Editor Mark Cudmore. Mark, good morning from London. Let's get your perspective then on what is, well, certainly through the Asian session, what has been a fairly positive equity trading picture, and the European futures picture suggests it'll be positive. I notice US futures picking up ever so slightly now as well. So as the S&P unwinds all its losses from the war period, how optimistic are you feeling about stocks from here?
Quite optimistic in the short term, a little bit of longer term kind of uncertainty. To put that in context, I've not been on the show for a few weeks, but a month ago in March, I was very much in the dynamic of, look, this is going to get worse before it gets better. The macro backdrop's very positive, but we haven't had the final escalation yet. Now it's a completely different scenario. What happened is now, I think short term, the optimism makes sense. First of all, negotiations are ongoing. Expectations for the weekend were always super low. So the fact that they did fail to reach an agreement wasn't a problem. The point is they didn't break down entirely. We still have negotiations there. So that's seen as a positive. Certainly investors are much more positive on the negotiations than they were a week ago. Second of all, part of the reason they're positive is that the blockade of Iranian ships is really, really smart. Ultimately, Iran was being seen as a strategic or economic winner of the war up until a week or so ago because its oil was getting out at elevated prices while the rest was getting blocked. And that's now been changed fundamentally by this. It's really cutting off their key kind of winning point. And then also the fact that the US Navy is going to implement a blockade of Iranian ports shows they've got enough naval assets in the region to soon start kind of building their own escort or kind of outlining their own safe passage through the strait, which means we're much closer to the reopening of the strait than we seem to be only a week or so ago. So around the conflict, the dynamic's very positive. The difference is, a month ago I was highlighting the underlying super bullish fundamentals. It was just the conflict that was really problematic. Now that we're positive on the conflict, I'm a little bit worried that the stagflationary impulse longer term from the war is being underappreciated because we really do have a supply chain problem that's yet to be fully flight, and that's going to linger.
What does short term mean? What does long term mean in what you've just described?
Yeah, really good question, Guy. I think the upward momentum continues until we either get a complete breakdown in talks, material escalation. I'm not worried about minor noise or minor hiccups, but like a material escalation, material breakdown, and it continues even further if we get a deal. I think it's only after we get to the other side of the conflict that people take the time to properly assess what are the longer term implications and how much they've been priced. So the short term, I don't have a defined term. It depends on the conflict. That great phrase, depends on the duration of the conflict. But I think it could sustain for another week or two.
Mark, briefly, where are those stagflationary risks that you're looking at further down the line most acute, do you think?
You know what? I think Asia is where some of the supply chain risks are, even though that had some of the best fundamentals beforehand. But generally, we've got a dynamic where I think that there's going to be upward pressure on long end yields is going to sustain, and that yield problem is going to filter through to other assets. It will see steeper yield curves. How much that stagflation impulse is to come through is still yet to be quantified, but that's where I'm focusing my analysis.
Bloomberg Markets Live Executive Editor Mark Cudmore. Well, Mark, thank you. And remember, you can get up-to-date analysis and insight from Mark, of course, and the rest of the team. Just go to MLIV Go on your terminal. Let's bring in Chloe Melly-Knight for a look at your stocks to watch this Tuesday. Chloe.
Good morning, Tom. LVMH is likely to be a little weaker this morning after sales at the fashion and leather goods unit, which is the most important division for LVMH, disappointed investors for the first quarter. So that is, of course, due to the conflict in the Middle East, which has really hurt consumer confidence globally, but also really impacted demand at the key shopping center of Dubai. And so we have seen the LVMH already underperform, and that could continue, especially because those weak sales are likely to really spook investors with that geopolitical turmoil overshadowing the progress that has been made elsewhere in the business for that luxury company. Moving on to Publicis, to the advertising world, with Publicis delivering pretty resilient earnings for the first quarter. That is despite the fact that the Iran war impacted business confidence and really the amount that companies are willing to spend on marketing and advertising. But despite that, Publicis has been able to deliver solid organic growth for the first quarter and maintain its full-year guidance. So that could reassure investors and maybe lift that share price a little bit after what we can see has been quite a tough start to the year for Publicis. And finally, oil is in focus, and BP in particular after BP said its oil trading results are going to be exceptional for the first quarter. That is because, of course, the Iran war has disrupted global energy supplies, sending gas, oil and fuel prices soaring as a result. And so we have seen Shell already say the same thing earlier this month about this oil trading boost. And so this is going to be really a theme for those oil majors as a whole. And we could see BP really extending those gains after what has been a really good run since the start of the year.
Chloe, thank you very much. Chloe Melly with those stocks that are in focus. I have to say I felt a bit better listening to Mark talking more positively about the kind of escalate to de-escalate strategy and what that might deliver, and that's where the hope in the markets is coming from. It's difficult to square that with what you hear from Fatih Birol, though, the lines around the long-term damage that this is going to cause. But I suppose both could be right. There could be long-term damage and there could still be upside for stocks.
To be fair, Mark's saying short-term good for stocks, long-term stagflationary impulse beginning to concern him. So I think that fits with and ties with what Fatih Birol was maybe saying.
Yeah, is this the back end of 2026 story when the pain point really comes through in terms of those higher prices as a result of what's happening, whether it's helium, whether it's aluminium, whether it's oil, and whether that is pushed out, and that is something that corporates have to contend with, but not in this earnings season.
Is it 2 weeks out? Is it 4 weeks out? Is it 8? I don't know. Do you have to resolve the conflict before you can make that calculus on what actually the damage has been done? Because at the moment the damage is ongoing, so you just put your hands up and go, I can't figure it out.
Yeah, it's interesting to see the strategy being adopted by the various CEOs. You know, some of them will have enough information to give new guidance. Others will just stick to guidance. Others will suspend guidance. And we're yet to get a sense of what's going to dominate.
Yeah, all I hope is that CEOs are very good at high jump, because the bar is very high in terms of this earnings season.
They've been put through their paces when it comes to margin protection, resilience and supply chains through COVID. So, that come to play as well in this earnings season.
We're about to find out. What are we, 5 minutes away?
5 minutes away from the start of the European equity trading session. Futures are pointing higher, looking for some positivity at the start of the European trading day. US futures flat to positive. This is Bloomberg.
A couple of minutes to go until we start trading here in Europe. So there's lots of different ways you can look at kind of how markets are performing. Let's start off with the kind of most basic. Did the market go from left to right in an upwards direction? Yesterday, the S&P certainly did it. Take a look at the kind of the fundamentals behind that. It wasn't a particularly inspiring session. Volume wasn't great. Turnover's not looking particularly fantastic right now. Is this a conviction trade? I don't know. Semis have had a very good run recently, and they are a big driver behind all of this. GS didn't have a particularly good day yesterday, but there was enough yesterday just to get us. There was enough hope. There was enough expectation that maybe we're actually on the right track to end this conflict, just to get the market to go higher. So that's what we've got to price in this morning, which probably explains why futures here in Europe are a little bit more positive, Tom.
Yeah, after modest gains yesterday in terms of what we saw across the European picture, just 0.2%. It was energy, it was financial services, the top of the list in terms of the sector-by-sector breakdown, as telecoms and utilities on the downside for European stocks yesterday. Futures then pointing to gains of 0.6%, pointing to a healthy session. FTSE 100 futures looking to add just 10 points. The outperformance could come through from the DAX. DAX futures pointing up by close to 190 points, up 0.8%. Anna, what are you looking at on an individual stocks basis?
Yeah, we've heard from a few corporates over the last 24 hours, and we have to factor in what they've been telling us, Tom. Let's start with the luxury space. LVMH very much in focus, ahead of some other luxury earnings. The fashion and leather organic sales number certainly disappointing, but some people are pointing out the Chinese business and the US business, the areas of future growth not too bad. So despite Middle East negativity, what do we see from the luxury sector? It could see some retreat at the start of trade. BP is certainly in focus. They are flagging exceptional oil trading gains as the energy price has been soaring, as we well know. And Publicis confirming its full year guidance despite the macro context. So we will watch for movement in any of those stocks, Guy.
OK, so we've got a lot to price in this morning, a lot to think about. Let's see exactly how the market is going to do that. Initially, we've got to price in a little bit out of the United States. Clearly, what is happening with the oil trade is going to impact London, the commodities story. Though BP, I do wonder whether its narrative, as Anna's just taken us through, will offset some of that. But the FTSE 100 is up by, let's call it 0.1%. How does the CAC trade this morning? What does the luxury story do? We'll have to wait and see exactly how that filters through. But LVMH is certainly a heavyweight in that market. So we'll work our way through that trade into the wider luxury space over the next few minutes. The DAX is called positive. The CAC is actually up 0.2%. The DAX is called very positive, though, this morning as the energy trade kind of feeds through there. We'll wait and see what the SMI does, but maybe a kind of midway point is the IBEX this morning. The Spanish market, Tom, up by 0.6%.
We're seeing upside that's coming through for the likes of copper, for the likes of gold and silver, and so basic resources is one of the gaining sectors, top sectors right now. I misspoke earlier, by the way. European stocks ended lower by 0.2% yesterday, but you did see the gains coming through for financials and energy. Today, basic resources near the top of the list, up 1.3%. Autos also gaining, a bit of a challenge session yesterday, so that's helping to lift the DAX then. The auto sector currently at the top of your list, up 1.4%. Tech is performing well. Again, guys, been talking about the gains that's come through for the semiconductor space, and you saw that in the Asian session as well. Tech today up 1.2% in the European session. On the downside, it is energy, of course, given that oil is below that $100 a barrel, and energy is down 0.4%. The biggest loser across your sectors so far, Anna.
Yeah, absolutely. Interesting that basic resources is doing pretty well today. We've seen, some of the underlying commodities go higher because of supply constraints, aluminium being one of those. But elsewhere within the commodities space, there's a focus on the possibility of a longer-term peace deal between the US and Iran and what that does to risk sentiment and sort of risk appetite, driving that particular sector a little higher. So there's a sort of number of dynamics, but they all add up to basic resources going higher this morning. And to answer your good question, Guy, about whether BP, how BP fares, given it's given some really bullish guidance, but at the same time the oil price is weaker. Well, it seems that the latter is in the driving seat. That stock down by 1.4% right now.
Yeah, in some ways that makes sense. Like if you believe in the optimism, if you believe that things are going to get better from here, oil prices are going to go lower, and you're going to maybe sort of see that more broadly. And people trade these as baskets. Like it's, in some ways, it's hard maybe to sort of separate out the single stock story.
Yeah, absolutely. And just to come to the luxury space, because we have consumer products and services now the worst performing sector, and the reason for that is LVMH down by just shy of 3%, and it is taking some of the other names within that space a little bit weaker. Certainly Christian Dior down by 2.7%, Hermes and Kering down just a fraction of a percent, but we're waiting for more earnings to come through from the luxury sector, so we'll keep that in mind. Let's talk to Peter Oppenheimer, Chief Global Equity Strategist over at Goldman Sachs, with us this morning to take stock of where we are. Peter, very good to have you with us. Thanks for joining us. So we've seen this narrative developing then in the last 24 hours, certainly, that with the ceasefire of last week, with the what seems to be suggestions that we'll be heading towards peace talks once again between these two parties before the ceasefire ends. There seems to be some optimism, some hope in the markets. Maybe stocks can decouple from what we've seen from energy prices. So is this a time to be loading up on US stocks? I mean, what's the Goldman Sachs view?
Well, our view is that the direction of equities is moderately higher at the index level. We think there's going to continue to be a lot of rotation beneath the surface, but we do think there's good value now in the US equity market. It's derated quite a lot, and underlying profits we think are going to remain strong. This will probably be the sixth quarter in a row of double-digit earnings growth in the US. So the multiple has come down from quite high levels. It's looking relatively attractive. And I think if we continue to see moderation in oil prices and some of the concerns about interest rate rises begin to fade, then I think we've got a reasonable degree of upside, and particularly in some of the things that have lagged behind in the market.
OK, so what's got better for the US stock environment since the start of the war? Because oil prices are $30 a barrel higher still. We've priced out some of the rate cuts that we were expecting. So I wonder what looks better to sort of justify us prices going back to the levels they were at the start of the war.
Yeah, absolutely right. There has been a deterioration in the mix of growth and inflation. That's true for the US. It's true for other areas as well. But I think fundamentally, the strength of underlying profits is really what's supporting equities. Now, expectations are high going into this season. But as I said, this has been a long streak of double-digit profit growth. And a lot of that growth is coming from areas of the market that have actually derated. I mean, if you look at the US in particular, tech profits are probably going to be growing at 40% year over year. Roughly 90% of the earnings are coming from that sector, and yet it is derated quite sharply. So I think part of the recovery in the US and maybe other markets is in the rebound in some of the areas that have pulled back, largely not because of the war, but because of concerns about disruption coming through in the tech sector itself.
You happy with 20% earnings growth this year? Is that what the US is going to deliver?
I think it's going to be less than that. But
how much less than that?
I think more in the low double digits, but that's still a reasonable degree of growth.
Well, the market's got much higher than that price at the moment.
Well, has it? I mean, the multiple has come down in the US from 22.5 times down to 19 or so. And a lot of the biggest stocks in the market have derated more than that. So I think as long as they're generating decent profit growth, and some of the biggest stocks are going to be generating profit growth well above 20%, then I think that's enough to continue to support the equity market to make moderate positive gains. I think a lot of the action in equities, as it has been in the last year, is really going to be beneath the surface, where we're seeing lots of rotation and lots of alpha opportunities and differential even in the same sectors.
Can the US, if the US economy is kind of starting to slow down, can that profit momentum remain?
It's slowing down, but from a very high pace.
Sure.
I mean, we're talking about growth, beginning of this year, around 3% at an annualized rate. That's above trend. It's certainly slowing, but we're still seeing positive profit growth and private sector balance sheets. What's driving that positive profit growth?
Well,
it's a combination of decent revenues. Remember, inflation is higher, so revenues are a function of nominal GDP, which has actually been quite strong, and still very, very good and healthy margins in a lot of the biggest companies which dominate the index. And that's been true in other markets, for example, in Europe as well, where you've seen a recovery in some of the sort of laggard, what we would call halo-type companies, those that in more traditional industries with heavy assets, but a lot of less competition for new degradation of those assets, and they're seeing stronger demand, and that demand in part is spilling out from the capex of the big technology companies.
It sounds like Peter's telling us that stocks are an inflation hedge.
Are they an inflation hedge? Are European stocks an inflation hedge, given the slower growth and the higher input costs for European corporates generally versus their US counterparts?
Yeah, well, again, massive difference between relative winners and losers, but in aggregate, you've got some higher inflation. Nominal GDP is still holding up quite well, and many of the more traditional industries, in Europe in particular, are enjoying a renaissance of demand, partly in relation to the desires to strengthen and build out energy infrastructure, as well as things like data centers, of course, but also in defense, which is increasingly a priority, not just for European countries, but for many others in the world as well. And that increase in spending is generating higher revenues and therefore also, in some cases, higher margins.
Where are you most concerned about margins beyond those sectors in Europe then?
Well, clearly in the areas that are around the consumer and that are very sensitive to higher input costs and commodity costs, because we have seen a very big rise in oil prices. That's spilled over into slower consumer spending and confidence, and spills out into some of the other areas that you were talking about, luxury, consumer staples and so on. Many of them have got quite high valuations. So I think there are some really interesting opportunities that are arising in the market. I talked about tech. If you look at it globally, it has a lower valuation now than industrials, for example. That's quite unusual. And so I think there are pockets of areas in the markets that are looking really interesting. And so while we may not see very significant rises at the index levels, I think we're still going to see lots of opportunity for investors to differentiate across sectors and within sectors as well.
Peter, we're going to be heading into the European earnings season. We're already in it, I guess. We've had some of some large companies reporting. It might be too soon for all the sectors to give us a huge amount of clarity as to how war in the Middle East impacts their business, or even what AI can deliver on the more positive side. So what are the areas of focus when we speak to CEO after CEO on this programme? What would Peter Oppenheimer like us to be asking them and focusing on?
Firstly, I should say in Europe, profit growth is not going to be as strong as the US again. The expectations for growth, we think of around 4% year over year. Only around half the companies will actually report on a quarterly basis. But within that, again, you've got massive differentiation. You've got banks up, we think, around 7%, energy stocks around 17%. But if you exclude those, actually slightly negative earnings in Europe. And I think there are really two areas that investors are going to be focused on. One of them is the effect of rising input costs and to what extent that may be moderating margins, or in some cases actually helping to support or boost margins. And the other, of course, is AI and technology. What companies are utilizing it and beginning to see any benefits from it. And anything that gives us more clarity on that, I think, will be well received by investors.
I thought the US economy was all about the consumer. Isn't it all about the consumer? Isn't the consumer under pressure at the moment?
It is under pressure, and we've seen some moderate rise in unemployment and consumer confidence we saw in the Michigan survey. Not great at all. But bear in mind, from an earnings perspective, it's important for the economy, roughly 70% of the economy, but less so for the market. The technology companies are still the bulk of the earnings, and they, I think, are going to.
So I can ignore the economy and focus on the market. They can tell me two very different things.
Very different.
Do they at some point have to reconverge?
We've seen the same thing in Europe. We've seen a tremendous year or so of returns in Europe, albeit coming off from the highs during the war, but very little economic growth. So I think these two things can diverge, and it's important to recognise the different drivers of both.
So pretty significant double-digit profit growth in terms of the US picture on the earnings front, around 4% on aggregate year on year for Europe. What about the UK? Before we let you go,
the UK, I think, is going to have stronger profit growth, partly again because the composition of the index, at least the FTSE 100, is very positively correlated with energy costs, commodity prices and so on. The banks also, we think, are going to do very well. Bear in mind the FTSE 100 is one of the strongest returning markets this year, up 6 or 7%, I think, at this stage. What's interesting is the FTSE 250 and the 350, which is more domestically focused, is very cheap and I think is overpricing weakness in the economy. It's trading at around a 15th percentile of its historic PE. And that compares to most markets, which are in the 80th or 90th percentile of their historic PEs. So the domestic market in Europe, I think, offers a lot of value.
We like to be gloomy here.
Yeah, in the UK, sorry.
We like to be gloomy here. Peter, great to see you. Thank you
Thank you so much.
Never gloomy. Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. Let's take a quick look at the Call 6 and figure out what is happening there. LVMH is a feature that we are certainly watching very carefully this morning. It is down by 2.5%. Everything else looks okay. Chip stocks in particular. Look at what ASML is doing once again. Take a look at the SOX index over in the United States. It has been flying. So we are seeing positive performances there. Novo's not having a bad day either. But let's go back to that LVMH story and get a bit more detail with Chloe.
Good morning, Guy. Indeed, as expected, LVMH is down. It's down about 2% this morning after the sales of its fashion and leather goods unit, which is the most important division for LVMH, really disappointed investors this morning. And so analysts are saying that the impact of the conflict in the Middle East on sales is really overshadowing the progress that has been made in other parts of the business, with particularly actually quite a good performance in the US and China. But that is kind of taking a bit of a backseat compared to the impact of those weak sales in the Middle East. So a bit of weakness there for LVMH. It's also weak across the board for oil companies. They are reacting to oil prices being down because the US and Iran are considering further talks to extend the 2-week ceasefire that is currently going on. And so we are seeing weakness everywhere, including for BP, which actually just said this morning that it expects its oil trading results for the first quarter to be exceptional. But that was not quite enough to offset the impact of those lower oil prices this morning. On the other hand, a sector that's reacted quite positively to this optimism around the likelihood of peace in the Middle East is miners. And so we are seeing that across the board with quite with a green across the screen for those miners. And in terms of metals moving higher, gold in particular is moving higher after a couple of days of weakness. And so we are seeing Fresnillo and Hochschild Mining, two gold miners, react positively to that this morning. And finally, the chip making equipment manufacturer BE Semi has received a higher price target from Bank of America. And so we are seeing that really boost the stock this morning, up almost 5%. We are getting the earnings next week. So that's also a name that we'll be watching out for.
Chloe, thank you very much indeed. Chloe Melly, of course, with some of the stocks on the move this Tuesday. Coming up, shares of LVMH, as Chloe was saying, lower this morning after sales results disappointed. What are the factors hampering demand then at LVMH? That is next. This is Bloomberg.
Welcome back. 18 minutes past the hour. Brent is dropping a little bit right now on the back of a headline that we're seeing from Reuters suggesting that the US and Iran could return to Islamabad for talks this week. Could return. One of the prerequisites seems to be the reopening of the Straits of Hormuz. There is no indication that that is happening. Crude is currently down, not at session lows, but we're down at kind of by 1.3% right now. So that's what we're seeing in terms of the market reaction to what we're getting on the geopolitical headlines. Let's talk a little bit about what we are seeing in the market this morning in terms of the sector story. Luxury under a little bit of pressure. Unsurprising, given what we saw from LVMH yesterday. Sales at the business's key fashion and leather goods unit falling at the start of this year. The Middle East conflict certainly hitting Louis Vuitton and Dior. Andrea Felsted, Bloomberg opinion columnist, joining us to discuss what is happening here. What do these results tell us?
Well, for me, they told us that the luxury recovery story is intact where it matters. Obviously, it's, sales have really been hurt by what's going on in the Middle East. But the US, no sign of the US consumer pulling back yet. China's fragile recovery seems to be going forward. In fact, in fashion and leather goods, the key division, both US and China improved in the first quarter compared with the last quarter of 2025.
Do you think that story is replicated by others in the space? I'm thinking of Kering, which reports later today.
Well, Kering has got this issue with Gucci, so we have to see whether
when does that become not an issue for Kering?
I think when sales start to go in the right direction, and I'm not convinced they are going to, because they've got their new designer Demna, and his products arrived at the end of February. A few of the see now, buy now from the catwalk show. Chanel's had a really strong response to its new designs. LVMH was saying Dior also is selling well from Jonathan Anderson's new designs. I'm not convinced the response to the Gucci products has been quite as exciting. So, I mean, I'm sure they will say they're selling well, but I don't think they're probably selling as well as some of the others.
Okay, so that's LVMH and Kering. We're also going to get numbers, I think, from Hermes. Is that Wednesday,
yes,
Andrea?
Yes.
Now, this is a business that has it almost been uncompetable with? I mean, such has been the demand and the long wait times for some of their bags.
Yes, it has. And now we are seeing that other people, particularly Chanel, are competing with it, which has raised a lot of questions about whether Hermes can continue to deliver. And it's going to be fascinating, because what we're seeing is the resale values for the Birkin and Kelly bags are starting to moderate. And when you look at the chart, you can see they really went up at the time of the luxury boom and have come down, which indicates that perhaps Hermes is a bit more cyclical and a bit more subject to the whims of the market than we thought it was, given those long wait lists.
Can I bring it back to your first point around LVMH and some of the fundamentals in terms of key markets?
Yes.
You're not worried about the Middle East. You saw a 50% drop in sales there. Not unexpected, given the conflict, I guess, but it was worse than estimated. But China is what I'm getting to, and whether or not you are confident now that China is materially back for luxury.
I don't think China's getting any worse. It's been sort of bumping along the bottom, I'd say, for the last 6 months, and there are signs that it is starting to improve. It's got an awful long way to go, but there are signs it is getting better. There is a bit more excitement around the new products, so it seems to be going in the right direction. The worry is that some of the issues from the conflict spill over to inflation, slower economic growth, and that hurts not only China but the US, where was particularly vulnerable to stock market swings.
Andrea, thank you very much indeed. Andrea Felsted from Bloomberg Opinion on the luxury space. We're going to be speaking with the CEO of Kering later, so we'll get some questions, no doubt, around Gucci. Catch our interview with Luca De Maio at 3:30 p.m. London time on Thursday. Don't miss that interview with the head of Kering.
Yeah, so coming up later this week. In the here and now, though, still very much focused on what's going on in the Middle East and oil prices. Oil prices falling on signs that Washington and Tehran may revive peace talks following the start of the US blockade at the Strait of Hormuz. For more, let's talk to our oil and shipping reporter, Waylun Sun. Waylun, good to have you on the programme. So let's start with the big picture around what's moving things, and then we'll get to some of your great reporting around individual vessels. But the diplomatic efforts seem to be doing something for futures, bringing futures prices lower. But in the physical market, the blockade and the fact that even less energy is getting out of the Strait than was previously the case, is the area of focus. So how do you add all of that up together? What's your focus this morning?
Exactly. So as you rightly pointed out, right, like futures markets are really headline driven. They are looking for signs of ceasefire, and that's why we see Brent and WTI drifting downwards since yesterday, because both US and Iran appear to be showing signs of goodwill to come to the table to talk. And also, crucially, even though the US has imposed a blockade, we haven't seen any flare-ups in attacks or missiles being fired from Iran into the region. So in general, there seems to be a floor right now. But of course, in the physical market, the longer each day that Hormuz is not open, the more barrels would disappear from the physical market. We already have a lot of the Persian Gulf producers shutting in production. Saudi Arabia and the UAE have tried to divert some of those flows to the Red Sea, but those are limited. We are talking about tens of millions of barrels disappearing per day. So that's a serious concern in the physical market itself.
Well, and I know you and the team, as Anna was suggesting, have been monitoring the individual ship flow through the Strait of Hormuz and the testing ultimately of this US blockade. One ship in particular, the Rich Starry, which is sanctioned by the US but is linked to China. Where are we in that story? Has it navigated the Strait? Is the US looking to potentially intervene?
That's a great question. So what we saw just maybe half an hour ago is the tanker itself, and mind you, it's an oil products tanker, it's not a crude tanker. So it's actually making its way down south into the Gulf of Oman. Its journey appears to be not inhibited by anything. But of course, we have to put a caveat that over there in the region, electronic interference is pretty severe. So ships may not appear physically where they are. But so far, throughout the whole journey, the ship has made its eastward journey from within the Persian Gulf after the US blockade, and it's now in the Gulf of Oman. So what are we looking out for here? And we have to bear in mind that this blockade that we are talking about is not the same one that we saw in the past few weeks, because when ships try to transit the Strait of Hormuz, that's actually in the hands of Iran, who has tried to attack the ships. But now when we see a ship safely exiting Hormuz, it's not an issue about Iran at all. It's about where the US Navy is. And currently, we don't know where the US warships are. We don't know whether the ship has safely made it out in the open sea yet.
Well, just a final quick question from me. The Saudis are worried about the Red Sea. How worried should the rest of us be about the Red Sea?
That is a big outlet for Saudi Arabia, which is a major producer for the OPEC. And they have been managed to divert some of those crude away, but not all of that, because its main outlet is still in the Persian Gulf. So around 7 million barrels per day through the East-West pipeline into the Red Sea. And about, if I'm not wrong, 5 million barrels per day is meant for exports. So that's the limit that we're looking at. Any further attacks on the capacity, on the output and the pumping capacity for the pipeline will certainly put the oil market to test. And already ships are not that willing to sail into the Red Sea because of fears of the Houthis.
Yeah. Wayland, thank you very much. Wayland Sun, oil and shipping reporter. Thank you for joining us. Coming up, we'll continue to focus on commodities. We'll talk to Eva Manthi, strategist at ING. Aluminium in focus there. This is Bloomberg.
This is the Open Trade. We are 30 minutes into today's session. We're seeing some optimism then across these equity markets, and that has been underscored by reporting suggesting that the US and Iran could potentially meet again to revive those talks around continuing the ceasefire or maybe even coming to some kind of deal. Across the European markets then, the benchmark's seeing gains of 0.7%. The last time I checked, it was the auto sector was on the upside in terms of the best performer across the sectors, energy on the downside. DAX currently up at 1% as a result of that, a little over that, and autos is playing that part there for Germany. 0.5% is the gain that you're seeing in the CAC current over in France, adding 42 points, and less strength coming through for the UK given the energy component, but nonetheless gains of 0.3% for the FTSE 100 so far. Guy, what are you seeing?
Gilt's having a pretty good day. It's basically kind of 5-1 in terms of up down. You've got 492 up, 91 down within the stock 600. look below the surface to see whether or not this rally is convincing. Yesterday in the States, certainly the underlying story, the volume, kind of what is happening in the turnover picture didn't look quite maybe as convincing, but certainly you saw the chip stocks doing very well. So volume also maybe painting the same picture here in Europe this morning. But back to that chip story, it is certainly continuing to be one of the leaders here in Europe. BE Semi's having a good day, ASML's having a good day. These are heavyweight stocks now. ASML certainly a heavyweight. BE's up by nearly 5%. Givaudan's having a fairly good day as well out of Switzerland, particularly the fragrance side of that business performing very strongly. That is what is being highlighted by that company on its earnings. It is being rewarded. It's up by 5.5%. The downside, though, we've already talked about it. ASML is the kind of the big upside gainer this morning, and LVMH is a significant drag. It is down by nearly 2% this morning on the back of the numbers that we saw. Andrea Felstead, though, painting, I would argue, a more positive picture. Imperial Brands reiterating guidance this morning, not seeing an impact out of the Middle East. It is being, though, as you can see, knocked lower by the market. What was the market expecting? Clearly more out of that business in terms of its earnings. Maybe an upgrade was what some were looking for. That's not what's happened. British American Tobacco also under pressure as a result of what we're seeing within that sector. So that's the kind of the stock market story. What are we seeing elsewhere? Anna.
Yeah, let's get a rundown of some of the other corporate news flow. We'll start with corporate news flow, at least, that we're tracking this morning here at Bloomberg. Bloomberg has learned that Amazon is in advanced talks to acquire the satellite operator Globalstar in a deal that would boost the tech giant's efforts to build its own satellite operations. Sources say a transaction could be announced as soon as Tuesday, but a final agreement has not yet been reached. Chinese President Xi Jinping says the global world order is crumbling into disarray. In his first public remarks since the Iran war broke out more than a month ago, Xi is also vowing to play a constructive role in the Middle East, positioning the Asian power as a stabilizing force amid the conflict. And the US Secretary of State Marco Rubio is to join working-level peace talks between Israel and Lebanon. That's set to take place later today. According to a State Department schedule, Rubio will join a meeting at 11 a.m. Eastern Time between the two countries' US ambassadors. Tom.
OK, let's get more details in terms of the constraints that are being put across the commodity space as a result of the effective closure of the Strait of Hormuz. Aluminium jumping to a 4-year high. Just one example. That was in London as President Trump's blockade of Iranian ports threatened more disruptions of shipments of that metal from the Persian Gulf. The Middle East accounts for about 9% of global aluminium output. For more on metals, Eva Manthe, commodity strategist at ING, joins us. Eva, can we start on the aluminium story then? At a 4-year high at the close on London markets yesterday, what is the nature, what is the extent of the constraints, the disruption that we've seen out of the Middle East when it comes to the production of aluminium?
For aluminium, the Middle East conflict is really a major supply shock. So now we're talking about 3 million tons of Middle East smelting capacity, which is roughly 4% of global supply, going offline. And it looks like it's going to be long-lasting. And that's already tightening an already constrained market. So even before the conflict, we are expecting the aluminium market to be in a deficit. So right now, on our numbers, the global aluminium market is heading for a deficit of around 2 million tons this year. And you can see the stress is most visible in the physical market for aluminium. You see premiums are rising, availability is tightening, and stocks in global warehouses are also drawing down. And Europe is particularly exposed. It's heavily reliant on imports after years of domestic smelter closures here. Europe is reliant on roughly 30% of its aluminium coming from the Middle East. And we've seen that dependence has increased further since Russian aluminium flows to Western markets fell sharply after the invasion of Ukraine. And for aluminium, we've seen already how sensitive this market can be to supply disruptions during that Russia-Ukraine conflict.
Eva, you're painting a pretty dire picture. Are the inflationary impacts of this, do you think, underestimated? How quickly could this unwind, that pressure and those constraints, if we get a reopening of the Straits of Hormuz?
I mean, for aluminium, these losses are really here to stay. So some capacity could return, but not very quickly. And aluminium damage to those smelters isn't easily reversible. So once you see those spot lines shutting down, restarts are very slow, complex, and capital intensive as well. So even if the conflict ends tomorrow, bringing that capacity back to the market can take 6 and up to 12 months. So that means that those supply losses we've seen so far are likely to persist even if geopolitical situation improves.
Eva, good morning. It's Guy. How much demand destruction would we need to see to balance the market?
So demand destruction is the biggest downside risk to our forecast. But it's not really about how high prices go for aluminium, where you see that demand destructions is about how long they're going to stay there and how long that conflict is going to last. So it comes down to for how long we're going to see that flows through the Strait of Hormuz being constrained.
Often we talk about if copper prices are high, aluminium is the substitute. What's happening with copper prices right now and what we're seeing in terms of the manufacturing process, the sulfur that's required? Give me a kind of sense of where you think the copper market is going to go and its relationship back into the aluminium market.
So you see copper prices trading at the highest actually in 1 month this morning, and that comes to all that optimism we've seen that the US and Iran will restart peace talks. And metals have really been hit by fears of rising energy costs and what impact that's going to have on economic growth. And today the markets are pricing in the easing of that macro conflict. So it's a very headline-driven market for metals. But in a de-escalation scenario, copper would likely outperform. If we see rate cuts, a weaker dollar, or a rebound in risk sentiment would also support copper prices.
What's in the driving seat then, Eva, for these metals prices? Is it supply restriction or is it hopes of peace? And I guess it depends on which of the metals you're talking about.
Yeah, exactly. It depends. So for aluminium, the story is really the supply risk, the supply tightening, and that's likely to continue to support aluminium prices probably till the end of the year, because we are likely not going to see that production that's already been constrained coming back in the next few months. But for metals like copper, it's the growth demand story is still the main downside risk. So if we see a more prolonged conflict, this would raise downside risk for growth and by extension copper and also other industrial metals demand.
Eva, how insulated is the Chinese market via stockpiling to some of the dynamics that we've seen, some of the higher commodities prices that we've seen?
So if you take aluminium, for example, there's really no supply issue for the Chinese market. They're the biggest aluminium producer in the world, of course, and they have China has a capacity cap on its production. So they have reached that at the end of last year. So there's not much more production increasing from China. But they really don't have a supply issue at the moment.
Eva, great to catch up. Thank you very much indeed for your analysis. We greatly appreciate it. Eva Mathi, commodity strategist, joining us from ING. Coming up, the HSBC CEO warning that the war in the Middle East could be denting global confidence. More from our exclusive interview. That's next. This is Bloomberg.
Welcome back. This is the opening trade, 8:43 here in London. European equity markets on the front foot as there seems to be rising hope and perhaps even expectation of a meeting, another ceasefire meeting between the US and Iran. We wait for details and watch stocks go higher in the meantime. Back to the impact that this is having on the global economy. HSBC CEO George Elhedery says the conflict in the Middle East is beginning to dent client confidence as investors navigate an increasingly volatile global landscape. Speaking to Bloomberg exclusively, he expressed concern that the war will have a much wider impact globally, but struck a resilient tone about managing this risk.
There has been a global trend of diversification of booking centers that's been taking place for a number of years now, specifically by our wealth management customers.
Right.
So they've been using booking hubs such as Hong Kong, of course, such as Singapore, such as the UAE, both in Dubai and Abu Dhabi, such as Switzerland, the UK, the US. And they have naturally been diversifying their wealth to be managed across multiple of these hubs, partly to be able to benefit from the expertise that each market brings, and partly as a matter of risk management. That trend continues. Insofar that this is this concerning the Middle East today, frankly, we have seen very benign movement. I think the resilience of the Middle East as a long-term hub for wealth management and capital has not changed. But of course, everybody's hoping to see the end of the current conflict and praying to see the end of the current conflict soon.
You're also a global trade bank, so what do you see in terms of change, if any, of trade flows? Do you see any of that since this war erupted? And how does it differ from maybe last year when we were talking about tariffs?
So trade has certainly been disrupted. Now, it's been tariffs of 2025 have disrupted trade with the US. This time we're seeing a major disruption in trade far beyond the Middle East, but in particular towards Asia because of the Strait of Hormuz closure. We believe there are multiple hundred, probably up to 800 ships that are still locked up in the Gulf. And, of course, the passage daily, 150 ships, has dropped to maybe 5 to 10 ships at best. So that is hugely disruptive. The impact of such will be felt way beyond the Middle East, and that is one worrying factor for us, not just in price of goods, oil, refined products, LNG, LPG, but also fertilizers, metals, etc. But it's also going to be felt in the availability of such goods. And we worry that a continuation of this conflict will have that impact globally, way beyond the Middle East.
That was HSBC CEO George Elhedery. Sticking with the banking space, Goldman Sachs' first quarter earnings revealed a surprise drop in bond and rates trading revenue, unnerving investors ahead of today's first quarter reports from other major lenders. Goldman CEO David Solomon addressing the bank's volatile quarter.
2026 began with a degree of optimism. Markets hit record highs and confidence continued to build, with most clients focused on growth, strategic activity, and capital deployment. As we've said, things rarely move in a straight line. And as the quarter progressed, the macro environment started to weigh on sentiment. Volatility increased meaningfully amid concerns around AI-driven disruption in sectors like software, heightened uncertainty in parts of private credit, and the conflict in the Middle East.
Charlie Wells is here with an update on Goldman Sachs. So, Charlie, what stood out to you? It wasn't all bad for Goldman. There was some pretty amazing strength that came through for the equities team, but there was that challenge around FIC. What for you stood out?
Tom, it really was that miss on FIC, on fixed income currencies and commodities that really overshadowed what was a strong report, a miss to the tune of $800 million versus analyst consensus, especially in this environment where there has been a lot of volatility, where there were expectations that that could benefit that desk. So again, analysts may be getting a little bit overly optimistic there, but there was reason for optimism, and we saw that come through in this equities trading beat. Goldman beat their own record by over $1 billion million, setting the best quarter, not just at the bank, but in the industry at large. So again, really positive news coming from there. But analysts had also been looking to see what that investment banking fee backlog might look like. And we got some indications that it might be softer going forward. So dampening optimism. If we flip and take a look at some of the commentary that came from executives on that analyst call, this is an earnings season where these calls matter just as much, if not more, than the backward-looking numbers. So we got David Solomon, the CEO, talking about private credit. We knew we'd get questions about private credit. We had Solomon really making a pitch for at least how Goldman does private credit. And again, an explanation from Dennis Coleman, their CFO, talking about that miss in FIX and talking about how their commodities business had been strong, about how currencies had been strong, but it was really where mortgages and rates tended to bring that segment down. So if you look at how the stock performed yesterday, it was really hit by this earnings report. The question as we go into the market today, does the market continue to see this as idiosyncratic or as part of a broader problem?
We're going to find out, aren't we? Got JPM, Citi, Wells is going to be on deck today. What are they going to tell us?
Well, look, we've seen, really positive stories coming through for Citigroup. So again, we're going to be looking for commentary about the transformation that bank has been going through. And if you look at their share price, beating Goldman for the past couple days, really. So again, comments there, but something to look out for. And this kind of in relation to yesterday, FIC to equities trading at Citi is high. So if there's a negative surprise from Citi, that could negatively impact the share price as well. JP Morgan under a little bit of strain compared to some of its peers. They actually have a lot of high expectations on FIC growth as well. That's something based on yesterday's report from Goldman to look out for. But JP Morgan as well, a differently shaped bank. And so we're going to get a different narrative. Let's look at where the revenue comes through at JP Morgan, because we'll get different questions, a different story. You see this big chunk here. That's consumer and community banking. So getting a view on the American consumer. We're starting to get questions about inflation, on creditworthiness. We could get a different indication coming from JP Morgan. So important to focus on that when it reports today.
Charlie Wells, thank you very much indeed. Let's take a look at what else we are going to be watching throughout the day. 9 a.m. UK time, so counting down to this, just a little under 10 minutes away. The IEA oil market report drops. We'll break that for you, of course. 1:30 p.m. UK time, different metric when it comes to inflation. Core producer prices, PPI, out of the US. European earnings, we've seen the luxury names under pressure today. Well, at least LVMH is. Kering is reporting later today. Total energy sales, they'll come through as well as revenue. And on the earnings front, as Charlie was saying, JP Morgan, Wells Fargo, Citi, plus BlackRock in the finance space and banking space, of course, reporting. And at 10 p.m. UK time, we're going to be hearing from Christine Lagarde over in Washington.
Let's talk about these markets. We bought the dip. Dip's been bought. SPX back to where it was. All good. We can move on.
Bonds are rallying, equities are rallying.
Conflicts in the rear view mirror.
Dollars down.
Buy stocks. Is that the right trade?
I think it's very hard to say in the next week or so. I'm racking my head around what this positivity is about, and to me it only has to be around ceasefire talks, the fact that they're still continuing, and you'll get hope that there'll be more talks next week. And we know the timeline was 2 weeks from the origin. Also, maybe we have another week of this positivity on the back of that, because, we have had negative things like US CPI last week that didn't really hit markets. Yes, it was better than expectations in terms of coming in lower, but it was still very hot. So we'll get US PPI later today, but I struggle to see how that shakes markets. We're getting earnings season, but it may be too early to see that negativity in terms of the stagflationary shock in those numbers. So I struggle to see what kind of stirs the market unless something very negative happens in terms of a deterioration in ceasefire talks, or maybe another party comes as an issue in terms of China with sending its ships through the strait.
Yes, I mean, that's something we're watching closely. The Chinese response has been interesting. It's been evolving, it would seem, over the last 24 hours. So you really don't think that any of the data cuts through, then, Skylar? So, and nor the earnings stories. So it's all just about one story right now.
I think it's because if it is a temporary shock, markets can look through it. So we'll get PPI later today, and I think it's not a huge number for two reasons. The first is, as I said, we got CPI numbers last week, and the market reacted positively to that, despite the fact that month-on-month inflation was up 0.9%. Now, PPI has already been on a hotter trend than CPI, and it does feed directly into the PCE numbers. And this number, again, is expected to be hot. So the second reason is there's already a high bar for it to come in hotter than expectations. And if the market wants to look through it because it thinks that there's going to be energy prices down in a month from now, then it can.
Bond market's performing well today, but you're pointing out that there's a divergence between European bonds and their US counterparts. What are the bond markets telling you?
Yeah, I mean, it's really interesting because equity markets are reaching for levels, particularly in Europe, that are kind of above Iran levels in terms of the levels we were seeing a month or so ago, whereas bond markets yields are still very much in Europe elevated. They're still in that kind of high range. And I think there's two reasons for this. One is if you think about the central bank response, we'll get some speakers later today, including Lagarde. And there's not a reason to get rid of that optionality for hikes. And that hike pricing has been very sticky because we've seen that there's been a reaction from central bank makers that they're worried about that inflation, even if it's proving to be only a few months that we get it. And then the second reason is just you're getting more bond supply, right? We've had more support out of some European economies. France, there's a little bit. Spain, there's more. We got Germany yesterday adding to that fiscal support in terms of lessening the impact of energy prices. And we've recognized that there needs to be a higher term premium as a result of that as you get that more issuance.
We can ignore earnings, right?
I mean, not entirely.
Okay. Within reason. Can I ignore earnings calls? Because they're the forward-looking... I want forward-looking information here. Are the earnings calls going to... Is it too early... The earnings clearly aren't going to show it, but the earnings calls might. Is that where I look for the volatility and the clarity, maybe, on what is happening?
Yeah, I mean, absolutely. If you start to see more negativity in those forward outlooks where companies are going, maybe airlines go, we're going to have prices increase quite substantially and we're not able to pass that on because consumers aren't as strong. Or if you look at the bank earnings later today and you see that consumer spending was already down prior to the conflict and maybe this just makes that worse, then certainly you can look at the future and be a little bit more pessimistic. It's just really, though, a question for a bigger impact of whether or not you can look through. So, yes, we may get earnings downgrades, but will we get earnings upgrades on the other side of that? And that really depends on where the energy price goes.
Okay, Skylar, with that in mind, thank you very much. Skylar Montgomery-Koning from the Bloomberg Markets Live team, and she was talking there about energy prices, very important to all asset classes, it would seem. And we do see oil prices a little bit weaker. This is futures down by 0.8% on Brent right now. We are still watching all of the action around the Strait of Hormuz. We take on board what our colleague was saying yesterday about about the electronic interference. So difficult to be entirely sure about where some of these vessels are. But the Rich Starry has attracted a lot of attention because it has been trying to clear the Strait of Hormuz, and as yet we've had no indication that there's been any intervention from the Americans. It's Chinese owned and suggesting it has a Chinese crew on board and suggesting that very loudly, which seems to be something that ships are doing to try and protect themselves wherever they are, perhaps.
The ships we don't know where they are the US ones. So we don't know where this vessel could be intercepted. There's two different blockades. They've got the Hormuz blockade, and then you've got... the US could chase this tanker across
We saw them chase across the Atlantic
exactly.
in the aftermath or in the run-up to what's happening in Venezuela.
Yeah. If you look at the MAC, it's made some progress during our 2 hours of being on live TV. China's come out pretty strongly during the 2 hours that we've been on. Some of the most vocal criticism, actually, of the blockade, or at least US actions around the Middle East. So they're obviously monitoring this as well.
Calling it dangerous and irresponsible.
Will the US intercept a Chinese-flagged vessel?
It would be a major provocation.
Precisely. But then that, if they don't, it undermines the whole case, because the idea is that the Iranians can't sell oil to the Chinese. And if the Iranians can sell oil to the Chinese, then what does this blockade do?
We'll keep watching the Rich Starry and
Rich Starry
and other similar vessels. Christine Lagarde is speaking later on today. In fact, 3 p.m. London time, we'll be hearing from her in an interview. So stay with Bloomberg TV for that. That's it for the opening trade. Guy is back with the Pulse next. This is Bloomberg.